Good afternoon, ladies and gentlemen, and welcome to the Shanta Gold investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and again, we'll send you an email to notify you when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and we'd be grateful if you would give that your kind attention. And I'd now like to hand over to Eric Zurin, CEO, and Luke Leslie, CFO from Shanta Gold. Good afternoon to you both.
Thank you very much, Mark. Thanks, everyone, for attending the Investor Meet session today with Shanta Gold. We'll be going into the presentation in a minute, and I'll be turning off my camera to give you the chance to have a full screen. And we'll be taking you through both the 5-year plan as well as the near-term plan, including the guidance revision and background to that. It's also important that we take questions from you and do our best to answer those questions in a timely fashion. So without delay, we will start here on slide 5 with a background to Shanta and setting the context for this 5-year plan. Because it's been 4 years since we presented our last mine plan to the market, and having done that and delivered on and exceeded what we set out to do at that time, we feel we're even more excited about this current 5-year plan and the journey to becoming a 110,000-ounce gold producer. Shanta has a diversified portfolio of very attractive growth assets. Our revised group-wide gold reserves and resources stand at 666,000 ounces and 3.2 million ounces, respectively, and demonstrate the huge potential in the portfolio. And both assets now in Tanzania have an extended reserve-based mine life to 2026 and 2029, which underpins our long-term sustainability and confidence in these assets. Now, Shanta has never been in such a strong position financially. We have a healthy balance sheet, including net cash of $24 million, effectively no debt, we're unhedged, and we have financial flexibility to fund and pursue our growth strategy. And despite the revised guidance today, there'll be no changes to that growth strategy, as well as our commitment to paying a dividend. We're cash flow positive. We have, as I said, a net cash balance on the balance sheet. We have unrefunded VAT totaling about $27 million, which has now started being returned, including a $4.2 million refund at the end of June last month, with that ongoing positive dialogue with the government of Tanzania. So a lot of flexibility and a lot of strength in our financial position. We paid our maiden dividend this year in April, and we're fully committed to that dividend going forward. Our robust fundamentals support this ambition of ours to become a leading mid-tier gold producer in Africa. On to slide 6. Now, Shanta hosts group-wide reserves of 666,000 ounces, grading 3 grams per ton as of the end of June. Group-wide resources, as I mentioned, are 3.2 million ounces when you take into account the West Kenya project, and that brings the grade up to 3.6 grams per ton. These are all compliant either to JORC 2012 or NI 43-101 classifications. At New Luika, which is our producing asset, gold reserves have increased by net approximately 50,000 ounces since the end of 2020. And that includes additional reserves from drilling in the first half of the year and includes depletion that we accounted for in the first half of 2021. The reserve-based mine lives at New Luika and Singida have been extended to 26 and 29 respectively. And these, again, recall our reserve-based plans, which don't include any new conversion from resources to reserves. Since the announcement of the last 5-year mine plan in March 2017, new reserves totaling 346,000 ounces have been discovered and added to the mine plan. which again points to the sustainability of extending the mine life and replacing mined ounces. We've said before, and we'll say again, exploration at New Luika Gold Mine is a core lever in our growth strategy of extending that mine life and adding value to this asset, which is very well invested. Now, turning to slide 7, which is a summary of the mine plan, and we'll cover the current forecast for 2021. So total production over the next 5 years is roughly about 500,000 ounces of produced gold. Notably, though, production is set to increase to 112,000 ounces in 2023 and average 116,000 from 23 to 25 with the introduction of Singida. What's important here is that Singida will not only increase production, but also give us a diversified stream of revenue from 2 assets and further reduce the risk of the operation. As we continue to invest in exploration at our West Kenya Gold Project, the prospect of the West Kenya asset joining New Luika and Singida as a 3rd producing asset, possibly from 2025, will increase. Now, this morning, we also announced an updated production guidance for 2021 from New Luika Gold Mine, which takes that production forecast to 60,000 to 65,000 ounces for the full year. We have had new geological information relating to a fault at the Bihania Creek Deep deposit that was recently detected during mining. The 2021 production plan incorporates negative grade reconciliation at this Bihania Creek deposit. Underground mining at BC has intersected a structure that has dragged and pinched the ore zone for approximately 17 meters along strike at 600 level, which is 360 vertical meters below the portal. And it's pinched and dragged the ore zone by another 37 meters at the 585 level, which is 15 meters deeper than that. Now, grade control drilling that we've been able to do recently has confirmed that the impact is limited to a zone spanning 30 meters along strike and 40 meters down dip, resulting in a loss of approximately 16,000 ounces, which was part of the 2021 mining schedule. Now, we expected to replace this shortage of ore from other sources, including BC East Area 1 and Luika West, which we recently announced over the last couple weeks, really, new indicated ounces at over 6 grams per ton. And while we expected that this shortage to be replaced by these areas, when we completed detailed design in the last 2 weeks, the amount of development required to access BC East Area 1, which is about 90 meters of development, proved that it was not practical to reach those areas in 2021, and hence we've revised production guidance and announced that today. Now, what does the next 6 to 18 months look like? Well, the plan now includes significantly more grade control drilling than historically completed. During the first half of 2021, and specifically in the second quarter, we completed a total of 6,000 meters of grade control drilling, which is about double what we would typically do in a similar period. Over 90% of the planned production over the next 6 months is now covered by grade control drilling, which increases our confidence. And importantly, all of the BC Deep area, which was the source of this recent disappointment, has now been grade control drilled for the balance of 2021 and 2022 production. Grade control drilling has narrowed the drill spacing from 40 meters in the resource model to between 15 and 20 meters underground. And historically, where we've had grade control drilling as a benchmark for predicting grade and ounces, we have had 4% positive reconciliation. At the Luika deposit, which is a source of production for 2022, the plan in 2022, we've completed most of the drilled holes at Luika West in the last 2 years in our exploration campaigns, and we've seen good continuity from those exploration campaigns. And so while we've increased our spending on grade control drilling to de-risk our plan, we believe the next 6 to 18 months specifically has been de-risked. We'll now cover some of the highlights from each of our 3 growth assets. And as we invest across our portfolio, we'll expect to realize some of the intrinsic value in each of these assets. Starting with page 9. And to recap, our 5-year plan now includes activities and investment across all 3 assets in Tanzania and Kenya. So starting with the new Luika gold mine, Shanta is among the safest gold mining operations that exist, and we have a duty of care to our employees to ensure safe and responsible mining. The rate of recordable injuries has declined sequentially since 2017, and on the right-hand side, you can now see we've surpassed 7 million man-hours, which is about 1,300 continuous days worked without a lost time injury. On slide 10, we've provided a split of the existing reserves at New Luika. And what you can see here is specifically that the bulk of the underground resources or the reserves for the mine plan will come from the Luika underground, being about 209,000 ounces, supplemented by other areas, including open pit and underground sources. So underground reserves account for 315,000 ounces, grading 3.5 grams, while open pit is the balance, 108,000 ounces of reserves, grading 2.1 grams. But the story here really is that resources sitting outside the plan amount to an additional 552,000 ounces, grading 2.4 grams per ton, which will be the target for resource conversion into reserves and mine life extension at New Luika. On to slide 11, where the production forecast in terms of grade, tons, and gold ounces has been outlined. We forecast production to return to between 75 and 80,000 ounces following 2021, and have forecasted that production in line with our reserve grade of 3 grams per ton. By the end of June, we also surpassed our expectations of increasing throughput at the plant to 2,300 tons per day. We've now reached 2,450 tons per day, which is 24% more throughput than we had just 6 months ago at the processing plant, on the back of a very modest investment. And when you compare that to 2017, the plant can now process 46% more tons than it could at the time of our last 5-year mine plan. Now, this is significant because as we target more open pit sources of ore at places like Porcupine South, across the region, in the Lupa Goldfield, the Unkuluizi deposit, within our mining licenses, so on and so forth, as we can produce or sustain higher throughput, the break-even grade can be lowered and more gold can be produced. I'll now ask Luke to cover costs, CapEx, in the 5-year plan on slides 11 and 12, and also cover upside potential on slide 13. Luke?
Thanks, Eric. At New Luika, we forecast an average AISC of $1,024 an ounce over the plan period, which generates a very healthy margin above the current gold price. Please note that the AISC is fully compliant with the World Gold Council and includes underground development costs. Key components of the average plan AISC are underground mining at $348 an ounce, processing at $166 an ounce, underground and open pit development costs at $134 an ounce, and mine overheads at $132 an ounce, royalty and selling costs at $129 an ounce, and stay in business capex, exploration and corporate overheads at $91 an ounce. Open pit mining contributes just $35 an ounce. Over the period, underground mining costs do increase into 2023 and 2024 by about 20%. And this is due to mining deeper. There is an increasing cost of tramming, so there's more diesel being consumed, more tires, and an increase in maintenance, as well as oil and other lubricants. This is largely offset by lower underground development costs during the period, which is also included in AISC. Plant costs are forecasted to be steady, with overheads declining slightly by 4% through to 2025. On to slide 12. New Luika CapEx. We forecast an average CapEx of $12.5 million between 2022 and 2025, $12.5 million a year. 2/3 of this is underground development CapEx, which is higher in the early years as more development takes place. And by 2025, we only have $2.8 million of underground development, with the open pits taking over. So you can see there $4.7 million of open pit mine development. Major items in the stay in business capital include power plant refurbishment and a new loader. On to slide 13. So this is a plan based only on reserves, so today's reserves. And we see lots of scope for upside, given the historic additions to reserves. As detailed here, we use a conservative price of $1,350 an ounce for the pit shells. 552,000 ounces of resources sit outside the mine plan, which includes the recently discovered Porcupine South deposit, which is waiting for a mining license. Inferred resources at depth across all of the underground deposits present an additional near-term target to convert the inferred there into reserves to further extend the mine life. The primary source of upside in our view is likely to be from new exploration. When we've historically allocated money to drilling, we've had a good success rate. And since 2015, we've added 462,000 ounces of reserves. Finally, we are exploring the possibility of adding another ball mill. So this would be the fourth ball mill to increase throughput by a further 14% to 2,800 tons a day. This would allow us to drop the cutoff grade further, lowering the hurdle for resources to be converted to reserves, but also the grade that we're targeting for new discoveries to make it into the next iteration of the plan. Eric, I'll hand back to you.
Thank you, Luke. What we'll do now is move ahead to slide 17, where I'll recap some of the key highlights of the Singida project. Singida is our second project in Tanzania. It's in construction and progressing on plan toward a production start date in late 2022. It's different to New Luika in that it's a greenstone deposit, which makes it more robust in terms of a geological setting, and has 243,000 ounces of open pit reserves grading 3 grams per ton. Now, Singida will do two things. As mentioned earlier, it will increase our production levels to 110 to 120,000 ounces per year from 2023. And it will also diversify our cash flows from a second revenue stream. Singida's current mine life is through to 2029, but there's 2 points to make here. One is that over 90% of the reserves are within only 120 meters of surface. So significant upside exists through conversion of additional resources which sit outside the mine plan. And that Singida's reserves, I think 87% are from 3 of these actual deposits, Gold Tree, Gem, and Corn Patch West, which gives us scope for additional exploration. And this isn't dissimilar to what New Luika looked like back in 2013 when it started production and had reserve extensions or reserve additions and mine life extensions. On to slide 18. Singida is forecasted to deliver 221,000 ounces of gold production at an average annual rate of about 32,000 ounces per year. The first 2.5 years of Singida's production plan has been defined by the equivalent of grade control drilling, which forecasts production of around 35,000 ounces at attractive open pit grades of about 3 to 4 grams. You can see here on slide 19 and then 20 that mine construction remains on track with first gold production scheduled for the end of 2022. Total capex is estimated at $37 million, including $10 million of pre-stripping, which will deliver 10,000 ounces of gold inventory to the stockpile. We plan on committing $17 million to Singida this year, of which about $7 million has now been committed. And key milestones reached in the first half of 2021 include orders placed and manufacturing commenced on the crushing circuit with Metso and the ball mill with NCP. Finally, pre-stripping at Singida begins later this month, and I'll be up at Singida next week to visit the local communities. On to slide 21, and again, just briefly, some of the key value levers from Singida include, as mentioned, 90% of the reserves being only within 120 meters of surface, so lots of upside below that mark, and 87% of these coming from 3 of the 7 deposits. Related to this, another number to keep in the back of your mind is that only 26% of the resources at Singida are actually in the reserve category, and so we believe there's scope for addition to converting more resources to reserves, which we'll aim to do largely once in production. Now moving on to our third project on slide 23, which is the West Kenya project. And this one is interesting, certainly core to Shanta's future value over the next 5 years, and an important lever for the company's growth prospects. Just to remind you, the West Kenya Gold Project is an exploration asset that we acquired from Barrick in 2020, so last year, for $14.5 million. It hosts 1.2 million ounces of inferred resources, grading 12.6 grams per ton. Since we acquired it, we've announced an independent scoping study in October with an average annual gold production of 105,000 ounces over a 9-year mine life, and resulting in a post-tax NPV of $340 million. But to achieve that, a lot of work has to take place, including de-risking the operation through infill drilling. And that's precisely what we're doing. On slide 26, we've now had visible gold confirmed and reported across the entire Isulu deposit at West Kenya, and that counts for about 700 meters of vertical extent directly from surface. Key intersections this year that we've been able to report are 6 meters at 220 grams per ton, 3.5 meters at 72 grams per ton, 4.5 meters at 70 grams per ton. Phase 1 drilling of 9,383 meters was completed in June, and a resource update will follow shortly. But first, we'll have the final drilling assays out from phase 1 probably in the next 2 weeks, followed by the resource update in August is our expectation. Phase 2 drilling targeting 200 to 450 meters below surface commenced in June, and as of today, I believe we've now drilled about 4,000 meters in that phase 2 program. So a lot of results to come from West Kenya drilling over the next couple of weeks and months. Now, on slide 28, just to summarize, over the next 5 years, Shanta is forecast to deliver excellent growth across our portfolio of diversified assets. We generate healthy cash flow and compelling upside, notwithstanding the downgrade we've taken this morning. We're committed to paying a dividend while pursuing our strategic objectives of realizing value from all 3 assets. So we're not going to change our investment profile across Singida, New Luika, or West Kenya. Given today's announcement, we've modeled our cash flows and confirmed that we'll continue as planned. The strength of our balance sheet is intact. We have financial flexibility, and our growth strategy is on track. With that, we'll conclude the formal part of the presentation, and we will start to go through the Q&A, which I can see here is on the right-hand side of our screen.
That's great, Eric. Thank you very much indeed, and to Luke for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. And again, we'll send you an email when that's ready for your review. I'd also like to remind you that your feedback is important to the company. And immediately after this presentation has ended, you'll be redirected in order that the company can better understand your views and expectations. Eric, Luke, we did receive a couple of pre-submitted questions ahead of today's event, one of which was about who your major shareholders are, which is available on this slide, which is available for download afterwards. But perhaps I could just start off the pre-submitted Q&A with the following question. I see that you've signed a contract with Capital for drilling rigs in West Kenya. Capital is reporting a tightening market for rigs. Is getting access to rigs an issue?
Yeah, thank you for that first question. Certainly wasn't an issue with us. We had access to this drill rig. It was already stationed in Tanzania, and it was available for use across the border at West Kenya. So we negotiated with Capital, and that rig was mobilized, I think, about 2 weeks ago. So, you know, what I'd say is anytime you have a commodity price increase, naturally there's new entrants, and that puts demand on equipment like drill rigs. But we're fine with our 3 drill rigs at West Kenya now. In terms of the second question, I think there was a reference to who our major shareholders are. We're seeing them all this week. We have that reported on slide 5 of our presentation. So Odey Asset Management's 11%, Sustainable Capital 6%, River Mercantile is 5.2%, Canaccord is 4.8%, BlackRock and Fidelity round out the list just below 4%.
That's brilliant. Thank you very much indeed, Eric. That is really, they're the pre-submitted questions. Obviously, you've had a number of questions that have come in from investors during the meeting itself. If you could open up that Q&A tab, and if I could ask you perhaps to read out the question and indeed who it's from and give a response where it's appropriate to do so, and I'll pick up from you when we get through the Q&A.
That's great. Thank you, Mark. So we'll go straight from the top and we'll work our way down. We'll answer all the questions that have been requested. And the first one comes from Hans, which asks, why do we think the market has reacted so negatively to the latest plans? Well, the simple answer is it was not expected, the production revision, and I suspect there's obviously disappointment on that. So we've worked hard already to mitigate that. We've set out our plans over the next 6 to 18 months, how we're addressing that. We've also confirmed that we're committed to the dividend, and there's no change to the plans around our strategic objectives. We've modeled our cash flows. We've discussed this in detail with the board, and we're committed to what we've set out already. So despite what we've announced today, there is no change to the strategies we have in place for realizing growth and for paying a dividend. The second question here is our guidance for 2021 was not met. So how can we take guidance for the 5 years as credible? Well, I would simply say that Shanta has been in production now for 9 years. We've set out what we said we would do, and we've done it. In 2017, the mine plan was set in the 5-year mine plan, and we've exceeded that. And you can see clearly that the guidance revision in 2021 was related to a revised geological setting, which we see as beyond our control. It wasn't related to anything safety-wise or production-wise in terms of physicals, equipment, and we've taken steps to mitigate any further risk. So our plan going forward is robust. You know, it's a 5-year plan we stand by. It's a reserve base at 3 grams per ton, which is what we've modeled the forecast around, and it's a plan we're basing our financial decisions on. Peter D has asked, production at New Luika Gold Mine is predicted to fall significantly in 2026. could we comment on that further? I'll draw your attention to a couple points. The first one is on slide, I think it's slide 15, so I'll just go back to that, which is pretty interesting. So let me just set the context of the plan we put out today, which is a reserve-based mine plan. And so what does that mean? It means despite the ounces in the resource category, specifically inferred, we haven't counted any of those in the mine plan that we published. And as an example, back in 2017, what we did here on the left-hand side of this slide, there was a reserve-based mine plan published. And you can see the same thing. Reserves at the time showed that the production plan would decrease to 62,000 ounces in 2022 and 37,000 ounces in 23. That was the plan in 2017. And how it works, these plans are you will continue to invest in exploration, targeting resource conversion into reserves to extend the reserve-based mine plan further. Now, what some companies do, which I don't think is just genuine, is they include resources in their mine plans. And I believe that's probably possibly pushing the envelope in terms of guiding investors in what's real and achievable today versus what's opportunistic in the future. So Peter D., our view is that through additional exploration ongoing over the next week, month, year, 5 years, we'll be able to add new reserves to the mine plan and extend out the mine plan beyond 2025, 2026, 2027, so on and so forth. Rich T. has asked, the part I don't understand regarding these newer high-grade areas you were drilling in Q3 and Q4, but in recent weeks found out it wasn't viable. What changed in recent weeks? What's made you think you could use them before but not accessible today? Now, what we expected when we looked at the mine plan back in Q2 was that the areas from BC East, Area 1, and Luika West, where we've announced new mineral resource estimates at high grades, above 6 grams, were going to be accessible to us in Q4, and that would make up the shortfall in the 2021 plan that we've experienced at Bohemia Creek. Now, in the last 2 weeks, when we've sat down with our mine planners and scheduled out the work, we've completed, typically what happens is every 90 days, so at the end of the quarter, we factor in depletion from what's been mined. We factor in reconciliations, both positive and negative. We factor in additional drilling results, and the mine plan is rescheduled on a rolling quarterly basis. And so that work happened at the end of June, and at the start of July, the mine planners concluded that actually accessing BC East Area 1, which has very good grades and is accessible from underground at Bohemia Creek, was not viable to do in the 2021 fiscal year. And so those ounces have been deferred into 2022, and as a result, presents a shortfall for Q4 and catching up on the plan in 21. To put that in context, there's roughly just under about 100 meters of development to do to access that area in BC East Area 1. And typically the jumbos could do roughly 3 meters per day of advance. That also means the jumbo a piece of equipment to do that development work will be shifted from a different area. And so I guess it's a trade-off, it's a balance, ensuring that we're meeting our plans for 2021 while not compromising those and moving equipment to other areas. Now, what we're looking at for 2021 in the second half is, again, we've optimized 2021, the second half, but we're also looking to see if what we can do to accelerate that work at BC East Area 1. There will be development work there. The question is, as the plan stands today, it won't access it quick enough. But what I'd say is the Tanzanian workforce is very I think, very practical in trying to find solutions to challenging problems. And whether that could be accessed quicker, as it stands today, it couldn't, and hence the revision to the 2021 mine plan. Hope that answers that one, Rich T. If it doesn't, please ask another question. We'll follow up. Paul L. has asked, please explain how much increased mill throughput doesn't lead. Please explain how much increased mill throughput doesn't lead to increased gold production. So to what extent has mill capacity increase already been factored in, and to what extent has there been a negative revision in ounces? Now I'm going to interpret this the way I think it's been asked. So what we have on the positive side, Paul, is increased throughput, which means more tons can go through the plant. Now on the downside, we have a lower reserve grade at 3 grams per ton versus historically the reserve grade and reserved ounces has been above 4.5 grams per ton. So there's a trade-off. Now, what we're looking at doing is adding a potential 4th mill to the production throughput. That wouldn't happen, that wouldn't be in place until 2022, and it hasn't even been confirmed yet. We're still doing the work on that. But we were very satisfied in adding the 3rd mill at New Luika because it gave us this production increase. And what that basically means is we can mine at lower grades from open pit sources and spread the overheads, the fixed costs, across a larger production base of throughput. So, again, the question here is, to what extent has mill capacity increase already been factored in? It has been factored in to this new plan. You can see here on slide 15, we've assumed 2,450 tons per day going forward from July 1st. And in fact, on most days we're hitting above 2,500 tons per day. But obviously there's planned scheduled downtime. So the steady state sustainable throughput is 2,450 tons per day, which is what's in the 5-year mine plan. James C. has asked, given the reduced near-term production guidance and resulting cash flows, is your expectation that the CapEx commitments envisioned by this plan for all 3 assets can be funded without further equity raises? Luke, if you're on standby, I'm going to ask you to take this question. The simple answer is yes, but I'd like Luke to comment on the flexibility in our cash flows and what the cash flows look like in some detail. Luke, are you okay with that?
Yeah, I'm here. Yeah. No, look, it's a good question. It's a kind of a key question. The way to think of this is that Singida starts producing in, call it 18 months. Over that period, we expect New Luika to be generating good cash flows, between call it $40 and $50 million. We got $25 million of cash today and no debt. So in terms of the uses of that money, we've got $33 million left for Singida before it starts producing. We've got $15 million over the same period of time at West Kenya. And although we do feel that it's a return to normal with VAT in terms of ongoing audits, you could assume that maybe there's ongoing leakage there of another $11 million. Anyway, it gives us quite a bit of cushion room at the moment, including the ability to continue paying a dividend.
Thanks, Luke. Yeah, I mean, lots of flexibility in the plan. There's no debt on the balance sheet. Cash flow is positive. The VAT is being refunded. And so as I said, we've reiterated once and we'll do it again. We're committed to the dividend and to funding the CapEx commitments, which is what we've discussed with our board over the last few days. So full commitment to all of that. Luke, finally, the question here again from Sam M. Is regarding the 2025 forecasted all-in sustaining costs. Is that dependent on increased production? What are the risks of hitting this $880 level per ounce? Luke, are you okay to cover that?
Yeah, no, of course. So look, a lot of the unit costs are driven by ounces produced, and it's why we've seen costs going up with it this year with the revised guidance. Actually, if we had produced, if the guidance was still 80,000 ounces, you'd see costs the same level. So costs haven't moved in aggregate, but on a per ounce basis they have. Now in 2025, production is particularly high because Singida is contributing 45,000 ounces. So that really helps bring the cost down. Eric, I don't know if that answers it. Is there another piece to the question?
I think that's right. I don't have anything further.
Okay.
I don't have any other questions on this board.
That's perfect. Eric, Luke, thank you very much indeed. You've addressed every question that has come in from investors, and thank you to those investors that have taken the time to submit those questions. Eric, I know investor feedback's important. We'll shortly redirect investors to do so and provide you with their thoughts and expectations. But perhaps ahead of doing so, I could just ask you for a few closing comments just to wrap up.
All right, thank you very much. I think what's important for us is to put the Shanta Gold story in perspective. It's been the asset we have today has been in production for 9 years. We've set on and delivered and exceeded the plan we set out 4 years ago in terms of the 5-year plan. We have the confidence in delivering on this next 5-year plan. What we noticed, obviously, or what we witnessed recently with the geological disturbance at BC Deep is isolated. It's in an area where it has limited impact on the future plan, but as I said, had an impact on the 2021 plan. It's disappointing, but we are moving forward from that and looking forward to the growth and realizing that value in our portfolio across the diversified assets. Thank you very much for your time, and we'll be closing the call now.
Eric, Luke, thank you once again for updating investors today. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Shanta Gold, we'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to you all.